danger. Even the most fierce gold bulls must be feeling sheepish, if we could mix that metaphor, after bullion tumbled by the highest degree in 30 years, the biggest one-day crash perhaps ever. That's raised questions about gold's value as part of an investor portfolio, but let's look at it first in the context of the broader commodities behaviour. It's not just gold, there is a broader behaviour in commodities, and with me to talk about that is Donovan Brahm, who is commodities trader at RMB, and Warren Jeffrey, who is head of research and trading from SMP Invest. Morning, guys. Let's start with you, Donovan. And there's been a lot of emotion, and these big jumps in prices sort of push people into extreme behaviour and extreme statements sometimes, and you get people at the opposite ends of the spectrum. Gold will never come back, gold will certainly come back, and so on. But generally the commodities have moved quite dramatically. How must we be thinking about this?
Well, I think there's been a sell-off across the curve, and if we look at what prompted that sell-off, or what sort of sparked the whole bomb, was the news out of China that China's not growing as fast as what we thought China would be growing. Especially industrial production is down in China, and you don't also have these fear factors, or as many fear factors as you had, say, about a year ago. So overall, the background to it has been very, very muted in terms of demand. And we, on a technical perspective, and I like the technicals, all the commodities just seem to be sort of lagging in sort of wide ranges and not making new highs and then selling off and selling off. And I think with the negative news or the negative statements from some very, very big gold bulls over the last month or so, I think that added to the negative sentiment, especially in gold, and what caused the sell-off. Like we've had some top investors in the ilk of Soros coming out saying they lightened their longs on gold and they're not as bullish as they once were. Then you had all these investment banks who were initially saying gold is going to 2,000 and everything, dropping their forecast for gold, some to as low as 1,200. So that, I think, created a very negative investor base for gold.
Let's pause there, Donovan, and we'll come back to gold, but let's talk just broadly your big picture of the commodities there, Warren.
Big picture of commodities, I think I agree with Donovan on that. I think there's a lot of emphasis placed on potential, what commodities hold for us going forward. I still think commodities have room to run, but I think investors probably just got a little bit ahead of themselves with their growth expectations from China. The reality is China's still growing at 7.7%, but investors were expecting 8% or more. So
that's what strikes me, Warren, is that the news wasn't especially bad. I mean, it wasn't like there was a huge shock about China. We said it was 8, it's going to be 5. I mean, it wasn't that sort of thing. Those numbers have been 7.5, 8. So why this reaction now to that?
Or to be honest, I think it's a situation where you've got a lot of speculators in the market trading geared instruments. So you get an exaggeration of any move in the market, and it tends to happen over a very short period of time. The moves tend to be very quickly because derivative instruments require margin calls. So you get a bit of bad news, it starts a cascade effect. And I mean, moving to gold, that's exactly what I think is happening in the gold market right now.
And I think I agree with Warren there in a big way, because one thing that I've always spoke about on the show is the whole issue of quick money. And if we look at these EFTs and all these new instruments that have come on board, like the SPDR instrument had over 46 million ounces of gold at the end of last year. So that's all quick money that can come in, that can be invested fast, and then can be withdrawn just as fast. And the thing is, when you have this negative sentiment, and we almost had the perfect storm in the last week with gold, you have this massive investor interest, and so when everybody rushes for the exit door, it's everybody falling over themselves. And for it to lose like more than 10 million since the highs of ounces invested in it is huge.
Now, some people who are moving are not looking at long-term trends. They're just moving based on what they see or hear today or last week. But it was pointed out that gold is in retreat. I think Goldman Sachs said this in recommending a sell for gold. In retreat after the largest rally in 9 decades. So this is a rally over this last decade in gold, and the largest rally in 9 decades. Of course, in other decades, the dynamics of gold were different. I mean, the price was fixed, for example. But the big observers seem to be calling a decline in gold.
The big observers are calling a decline in gold, and I think one of the reasons for that is what Warren highlighted. There's still a huge amount of investment interest in it. And what we've seen on the ground, for example, is still a steady buy of, for your small guys in the street, the guys that want the physical gold, there's still a huge interest in buying physical gold. In fact, in this sell-off in the gold period, where let's call it paper gold has been sold off, your you've had record sales in the USA and other places of gold medallions and gold coins. So it's almost like conflicting views. But the guy that buys your gold coin doesn't buy it for a 10 Rand profit. He buys it for a long-term hold. So you have that dynamic of where your investor interest, your investors, I think, are going to be still selling gold for a while, but your guy that actually wants the physical, that is interested in that minted Mandela coin or Krugerrand coin, they're still going to be buying it. And we're seeing huge buys going into India at the moment.
Warren, you see the comments swirling around. Some analysts from the following places are saying that sort of comment, and we don't need gold as a safe haven anymore. That's the kind of comment that's come out. Is that valid?
I don't buy into that. The reality is we've got a lot of artificial currencies, for lack of a better term. Just in terms of the dollar, the yen, all of those safe havens, they're the biggest contributors to quantitative easing and stimulus packages and that, which are all undermining the value of those currencies. Gold is something you can't just go and print more of. Gold will retain some sort of value. Now, like you said, gold's had a big pullback, but it was probably due a consolidation. It's had a massive run over the years. Guys were calling a gold top at $900 not that long ago, and
well, 5 years ago, I think it was at 900.
Yeah, exactly. So we have had a significant pullback, but I also think in this particular situation, my personal view is now is probably a good time to be looking at getting into gold. From the point of view, there's a lot of controversy surrounding this recent gold pullback. Just looking at the volumes and how the sell-off actually happened in the US on Monday, we had 100 tons of gold sold in one go. It's by an unnamed fund or institution. That triggered or managed to push it through its technical level of $1,540. Once it gets through there, like I mentioned earlier, you get a cascade effect. Stop losses are getting hit, investors are getting out. And then straight after that, within a 30-minute period, the same fund sells 300 tons of gold. I mean, collectively, that's a $20 billion position.
We talk conspiracy here. Remember when the Rand was getting so weak and they said that someone must be doing this on purpose, Donovan?
I think the big thing is the world, many traders trade on technical levels. And when you, we've tried that 1550 level a couple of times and then we bounce, but then we don't bounce as high, then we try it again and then we bounce, and then we don't bounce as high as we did the previous time. So finally, when we break through that 1550 level, it's a level that's big in everybody's minds. All your top charters are speaking and publishing the same levels in their different articles. So lots of people are watching the same levels. And that's what contributes to the massive fall that you see when you break through those levels. But I think coming back to some of the background on it and looking at some of the other metals, for example, looking at oil, looking at copper, and I know that there's some people that believe that the other commodities fell because gold fell, and sort of like the commodities generally trade in the same cycle, but I think some of those commodities have been under pressure way before the gold fall. For example, if we're speaking about China and we're speaking, there has been a significant slowdown in China, despite, as you say, those growth numbers are, when compared to the rest of the world, are impressive. But we look at feeder stock, like, for example, coal into China. The imports of coal have been way down compared to what, not even what everybody thought there was going to be, but what was in the last 2-3 years.
In fact, Peter Major, earlier in the program, he was talking about how coal has been flat.
It's been depressed, and we look at other sort of metals that are used in the bull industry, like rebar. Rebar at least bounced back a bit now, but it's still fairly depressed. And we look at copper, and there's a huge amount of stockpile, above ground stockpile, that's not been utilized. And so there's definitely a slowing down of things, and that's feeding into the sentiment into the gold market as well.
Of course, a lot of copper keeps getting stolen and fed back into the market, which also depresses the price. But to get simple again with inflation, people say if there's inflation and people are printing money, then you need that backup, that gold. Global inflation peaked at 4% in 2011, and it's been falling ever since. Now, that's quite a dramatic number. But all this money that's coming into the system, the Bank of Japan, and this dam of money, in the end, Warren, the logic says that gold's got to come back to compensate.
Well, that would be my argument, is it has to come through at some stage. At the moment, the world's not feeling the effects of all this stimulus coming through, because the real growth isn't there. America's not in a rosy position where they can just say, oh, well, let's stop stimulating, despite what the Fed might mention in that. Just look at the jobs numbers, just look at manufacturing. They have a good month, they have a bad month, good month, bad month. Their consistency is not there that you can actually pull the stimulus out. And as long as that stimulus is there, they're driving the case for real assets.
All right, I'm going to...
And what's also happening is, and what we're not mentioning is the fact that some of the investor money that gold has attracted is moving to other markets. For example, if we look at the Dow and what the Dow has done over the last few weeks. So gold is competing purely as a financial instrument to attract investors, and there's some investments that are looking much better. We see it in the Rand at the moment. We see that big flow into bonds again. And so gold is competing in a market for investor flow.
And we were talking earlier about how South African bonds are attractive to Japanese investors because of the money that's coming in. Quickly, I know you guys are professional guys and these things are complex, but people like a simple prediction. How low is gold going to go, Donovan?
I reckon I'll start buying it again at around 1250.
And it's going to get there, is what you're saying, Warren?
I don't see gold going much lower in the near term. I'd say probably 1340 is probably the low that I've...
Well, what will be this morning, 1370 odd?
Yeah.